Strategy sold a special kind of preferred stock, ticker STRC, and pitched it to investors as a stable, high-yield place to park cash, almost like a savings account. It was engineered to trade right at $100. It's now in the 70s and yielding around 15%. That's the market's way of saying it's nervous. And then this, for the first time since 2022, Strategy sold Bitcoin, not to take profit, but to pay a dividend. Two flashing warning lights at once. So today, can Strategy, the company formerly known as MicroStrategy, actually default? Let's open the capital stack. Quick line first, this is education and analysis, not investment advice. Nothing here is a recommendation to buy or sell anything. Here's where things stand in late June 2026. Strategy holds roughly 845,000 Bitcoin. That stack is worth about $50 billion. But here's the catch most headlines skip. They paid an average of about $76,000 per coin, and Bitcoin is trading near $59,000. Strategy is underwater on its Bitcoin by around 20%. There's no built-in gain cushioning anything right now. To understand default risk, you have to see who actually has a claim on that Bitcoin. Think of it as a ladder. When money comes in, the top gets paid first and the bottom gets whatever's left. At the top, about $8 billion of convertible debt. Next rung, the preferred stock tower, call it $15 billion across 5 tickers, STRF, STRC, STRK, STRD, and the Euro 1, STRE. And at the very bottom, the common stock MSTR. So, $50 billion in Bitcoin, minus $8 billion of debt, minus $15 billion of preferred. What's left for common shareholders is about $27 billion. Now you'll hear a scary number, that MSTR trades at about 0.6 times its Bitcoin. That's misleading. It only looks like a discount because the debt and preferred, about $21 billion in senior claims, sit between the common and that gross Bitcoin. Strip those out, and the common is backed by roughly $27 billion of residual Bitcoin, against a $30 billion market cap. So it actually trades at about 1 times the Bitcoin it can really claim. The real story isn't that the stock is cheap, it's that the premium collapsed. For years, MSTR traded at 2 to 3 times its look-through Bitcoin. Today, it's around 1. Hold that thought. So why is Strategy suddenly issuing all this preferred stock instead of just selling more common like it used to? Not because it can't, because it stopped being worth it. Here's the old flywheel. When MSTR traded at 2 to 3 times its look-through Bitcoin, Saylor could sell shares far above the Bitcoin each one claimed, buy more Bitcoin, and leave every existing holder with more Bitcoin per share. That's accretion, and at a 3 times premium, it was a money machine. Now the premium is gone. At about 1 times issuing shares is just a wash. $1 raised for $1 diluted. The engine didn't reverse, it ran out of fuel. Enter the preferred stock. It lets Strategy raise cash without issuing common. STRF pays 10%, STRD 10, STRK 8, and converts, and STRC, the big one, is variable around 11.5%, designed to sit right at $100. There's a second reason. Saylor used to hold majority voting power through super voting shares. Years of issuing common to buy Bitcoin diluted him below 50%. He's now around 44%. More common would dilute his control further. Preferred doesn't carry that vote. So the pivot does double duty. It raises cash the common market won't and protects Saylor's grip. The math is the main driver. Control just reinforces it. So, where's the actual default risk? The surprising answer is not the debt. At least not soon. Those $8 billion in convertible notes carry almost no cash interest, maybe $80 to $90 million a year, because most were issued at 0 coupons. And the first one doesn't mature until 2028. There's no near-term debt wall. The real pressure is 1 rung down, the preferred dividends. All those preferred coupons add up to roughly $1.7 billion a year. Cash on hand? About $1 billion. That's under 10 months of dividends in the bank. Normally, you just issue more preferred. But STRC slipped below its $100 target into the 70s. At a $74 price, its $11.50 payout is a yield near 15%, and if it's ever called back at 100, a buyer pockets another 30+%. The market is pricing in real doubt the anchor holds. That's not a money market substitute. That's a distressed credit yield. So with the common ATM off and the preferred ATM stalled, dividend money comes from cash, the software business, and, as we saw in May, selling Bitcoin. That's why 32 coins mattered more than $2.5 million should. It signaled the order of operations had changed. Bitcoin went from the thing you only buy to the thing you sell when the bills come due. So where can this go? 4 paths. 1. Recovery. Bitcoin rallies back above cost. MNAV climbs over 1. The flywheel restarts. Dividends get easy again. Don't bet against this at some point. 2. Muddle through the base case. Bitcoin drifts sideways below cost. Strategy funds dividends with cash, software profits, and small Bitcoin sales. No default, no growth. A slow grind where the pile shrinks instead of grows. 3. Stress. Bitcoin keeps falling. Strategy suspends the junior dividend first, STRD, which it can skip cleanly. If it worsens, the cumulative ones pile up unpaid and bigger Bitcoin sales follow. Not a legal default, but it feeds on itself. Selling pushes Bitcoin down, which makes raising money harder, which forces more selling. 4. Genuine default. For this, Bitcoin has to stay deeply depressed for years, into those 2028 to 2032 maturities. If strategy can't refinance and can't sell enough Bitcoin to cover the notes, that's a real default or restructuring. Tail risk, not base case, but no longer unthinkable. So which is most likely? Honestly, some blend of recovery and muddle through, a choppy grind with the occasional scare, is the base case. Stress and default only take over if Bitcoin stays broken for a long time. The point isn't to predict which path wins. It's to understand the ladder you're standing on, and to know which rung cracks first. There's one more layer, and it flips the whole story. Saylor designed strategy as a leveraged bet on Bitcoin. When Bitcoin rises, the debt and the preferred amplify the gains, and money pours in. But leverage cuts both ways. In a bear market, that same structure amplifies the downside. And some traders now treat MSTR common as a leveraged way to bet against Bitcoin. And it can feed on itself. With preferred dividends to fund, convertibles coming due, and the stock stuck below its Bitcoin value, strategy may be forced to sell Bitcoin into a falling market. That selling pushes Bitcoin lower, which pushes strategy lower, which forces still more selling. The vehicle built to soak up Bitcoin could become the thing that drags it down. That reflexive loop, not a single missed payment, is the real risk to watch. So, can MicroStrategy default? Yes, but probably not the way the doom posters say. The near-term risk isn't a missed bond payment. It's a slow-motion squeeze on the preferred dividends, paid for by selling the very Bitcoin the whole thing was built to hold. Watch 2 things. First, MNAV. Right now it's hovering around 1. The real warning is if it actually breaks and trades below 1, because that means the market is valuing the whole structure for less than the Bitcoin inside it. Second, strategy's funding options. Watch whether it's forced to start selling Bitcoin in serious size to cover the bills, or whether a white knight rides in to refinance and save the day. Those 2 tell you whether this stays a slow grind or tips into the doom loop. If this made the capital stack click, subscribe. The next episode asks whether the other Bitcoin treasury companies copying this playbook are even more fragile. And drop a comment with the ticker you want me to break down next, STRK, the miners, or one of the new copycats. I read everyone. One more time, this is analysis and education, not investment advice. Do your own work and talk to a licensed professional before making any decision.